Thank you very much. So the topic for today is discussing the idea for an approach for analyzing and managing macro financial risks. The issues I've listed here, you know that macro financial risk propagation, sometimes referred to as systemic risk, one of those things that's not so easy to define, but people seem to know it when they see it, is a big issue, of course, for governments, for financial stability, for the economy, but it is also a big issue directly for large private sector or even government asset pools. The reasons being that those entities that are managing enormous asset pools are too big to be able to get out of the financial harbor even if they know that big systemic risks are headed potentially that way. They're just too big. And therefore, they too need to understand, to be able to analyze, and develop tools and means of trying to protect their constituencies' resources in an environment where the option to just leave or get out of town is not a feasible one. So I'm sure you know this is there. The other is for those of you who are either interested in finance, if you're students, are in finance, if you're faculty, or if you're from the practicing community. I consider this area of where I'm going to show you how you bring the tools of finance as one that's a very big growth of research and growth of opportunities. This is generally an area more often populated by another part of the barnyard of economists called macroeconomists. But I think finance, with its focus exclusively on risk, brings a dimension to the problem, both practical and conceptual, that greatly enrich the models. So that's a way to interpret it. Now, as you're well aware, the financial crisis, certainly of 2008-9, and I don't know what you want to call Euroland, a continuation of that, or a second one of 2010-11, and maybe in some sense still ongoing, really centered around credit risk, that and money markets. And the propagation of credit risk among institutions and sovereigns is related to a degree of a notion of connectedness among them, which I will quantify and discuss with you. And what I want to propose to do here, as the title suggested, is to show you some tools that we've developed, my co-authors and I, for measuring this connectedness and, importantly, its dynamic changes, how the connectedness changes through time. And we approach that using, of course, finance theory, but we're implementing some ideas from network theory and econometric techniques. Now, I want to emphasize to you that this is new research still in progress. The scientific paper, the formal scientific paper, is about to come out, not to be published, just to be circulated fully. There was a teaser published in the Financial Atlas Journal, which is similar to what I'll be saying today. But I want you to understand the numbers may change. We're going to do a lot of things that are different. So it's a work in progress. But I've chosen to present this here to you now because I'm sufficiently confident that the basic approach that we're taking and the findings in terms of what I'm going to emphasize to you are well-founded. My co-authors are not to be indicted if I turn out to be wrong. This was my decision. They agreed to let me take the risk as well as any return if there is one. Okay? So you're looking at something that's in progress, all right? But for which I'm willing to say I think this is an approach that will work. All right, with that, let's tee up. Now, as we all know in economics, there's a trade-off. Nothing is free. There's no free lunch. So there are two parts to my talk. The first part is the structural, conceptual part that some of you may know, some may not, but we have to do it because if I don't give you the structure, if I don't give you what's the underlying conceptual base for what you're going to see, then if I only show you the data and the analysis of the data, you're going to say, look, there are 28,000 coefficients there. 28,000. That's a bunch of numbers. What does it mean? So you need to know the structure. So the price you have to pay to see the pretty pictures at the end, and they are pretty pictures, I think. Okay? So mostly it's pictures. We all like pictures, right? But to get to the pictures, you're going to have to do some structure. And since it's about the connectiveness, specifically with respect to credit risk, my first structural task for you all today is to make you credit risk experts, or at least expert enough. And we've got about 10 minutes that I'm going to spend to make you an expert on credit. So let's see if we can get there. Ready? Okay, let's go. Now, what I have in mind here, and please forgive me, I'm going to be talking in US dollars. You can translate it. What I have here is a mortgage, a corporate bond, a bank loan, some form of credit instrument, standard sort of thing, you know, nothing fancy, in dollars, US dollars. What I have here is a full faith and credit US Treasury, US government guarantee. We've issued a lot of these, so this isn't a complete hypothetical. If I take the two of them and staple them together, what do I have functionally? A risk-free loan. Why? Because either the issuer, the borrower who gave me the mortgage or the corporate loan or the bank loan will pay me, or if they don't, the US government will. And I'm willing to ask you, or I'm going to ask you to stipulate that in US dollars, a full faith and credit US guarantee is risk-free. If you want to give it a haircut, fine. I'm not. Okay? So we have here something other than collateral or tax that's exactly equivalent to a risk-free US government bond in dollars. Okay? Well, now, unfortunately, I'm going to rip the guarantee off, and we're back to the bond mortgage. Well, if you agreed the two together was a risk-free bond, then what is this? It's a risk-free bond minus a guarantee. You see the logic? There's no special model here. This is just a structural statement. Well, first lesson from credit risk, first lesson is that every time you make a loan, you're actually engaged in two quite different financial activities. The first is you're making risk-free lending. You lend money now, for sure you're going to get it paid back with interest later. Maybe not much interest, but you'll get it back. That we all understand. Time value of money. So that's not very interesting, but it's important. What else are we doing? We're minus a guarantee. What does that mean? Minus something means instead of owning a guarantee, we're writing a guarantee. We're short a guarantee. If you like short better than writing. What's a guarantee? It's insurance. So when you lend money, you lend it risk-free, time value of money, but you're also in the insurance writing business, a very old and honorable business. But it's a business that has risk. And so you should understand as a lender that you are in the business of writing insurance. So they're quite different businesses. So if you think of it that way, you'll have a better understanding of what credit is really about. Two activities, lending risk-free and writing insurance. Now I'm going to take you a little further. If you look up here, I put up a balance sheet. Think of it as market balance sheet, not a GAAP accounting, for a corporation. On the left side, you have its assets. On the right side, very simple structure, it is debt and equity. If you prefer, you could substitute for corporation household. On the left side, you could put for the assets house. On the right side for debt, mortgage. Okay? Your choice. I'll do the corporate. Now, let's say that the debt is that the corporation promises to pay $1 billion, B dollars, at some date. That's the promise payment. That includes all the interest and everything. It's a single payment. Make it simple. When we get to the maturity and we show up with our debt instrument to the corporation, one possibility is the corporation says, here's your $1 billion, here B dollars, we take this in. That's fine, right? You got what you were promised and you go. What else could happen when you show up? You show up and say, I want my $1 billion, and the corporation says, sorry, we can't pay you. Now, at the level I'm talking, we can get into bankruptcy and all these details. Every debt contract has a feature that, at its core, that if the borrower doesn't pay what was promised, the lender, the creditor, gets to seize the assets of the borrower, whether it's a corporation or an individual institution. Agree? That's a core of lending. So in the simple terms here, if you show up to the corporation and you don't get paid, what do you get instead? When you cut through all of, again, the legal negotiation, at the end of the day, you get the assets of the corporation. Now, what do you know about the market value of those assets? If they didn't pay you, they're not worth $1 billion. They certainly weren't worth $2 billion, because if they were, the company would have sold some of them and paid you. They're not going to give you more assets than you've been promised. So you're going to get less. Agreed? So you either get what you were promised, the $1 billion, or you get the assets. What's the value of the guarantee? The guarantee always pays you, yes? Now, in the case where the corporation pays, the guarantee ended up being worthless. That's insurance that you didn't need. But if the corporation doesn't pay, the guarantee pays you your $1 billion. So what was it worth at the end? The $1 billion you did get minus what you would have gotten if you didn't have the guarantee, which is the value of the assets. Symbolically up here, if A is the value of the assets, then the difference between B, what you were promised, and what you would have gotten without the assets A, B minus A, is the value of the guarantee at the end. All agreed? Well, you can write that payoff succinctly as the maximum of 0, meaning you get nothing, the guarantee is worth nothing, or B minus A. Someone please tell me, does that look familiar to you from any class you've ever taken in finance? Does that payoff look familiar? Oh, I saw some heads go up and down. That's enough. Thank you. All right. Well, if you've studied finance or you're in finance, you'll recognize that is the structural payoff to a put option. What is the particular put option in this case? The exercise price of the put option is the promised amount of the debt, the $1 billion. And the put option is on what asset? The asset of the borrower, the corporation. Now, why do I point this out to you? Of course, I had to do something with options. I had to do something with you with options, right? But there's a reason for pointing out this to you, which is we have an enormous amount of knowledge and experience, learning curve in the real world, as well as an enormous amount of research on options. More than 40 years of concentrated things with traded markets of all options on all kinds of things. So we know a lot about the structure of options, their risks, their pricing, etc. So if you know about options in your first finance course or your second one, wherever you were first introduced to it, you're now going to get some payoff for your work because you're now becoming a credit expert because of your knowledge of options. Why? Because the guarantee is nothing more than a put option on the assets of the borrower. And all the features, you know, the fact that if volatility goes up, the value of the option goes up, which makes sense, right? If there's more uncertainty of the thing you're insuring, the insurance is worth more. All those features that you learned, if you didn't, you will learn, I hope, soon, motivated maybe by this. So you know what credit is. Credit is nothing more than lending money risk-free and writing put options, writing insurance. And you have all that structure. Now we're going to use that. Here's some pictures. This is a picture of the price of the debt that's risky, the top one, as a function of the assets of the borrower. And this curve. And so it says, at a given point in time, given these terms, here's the value. And the higher the assets, the more valuable is the debt. Why? Remember what the debt is. It's risk-free, that doesn't change, but it's minus the value of the insurance. The higher the assets, the less valuable the insurance. Hence, the more valuable the debt, because remember, the debt is minus the guarantee, or minus the put. All right? Since the real action here is not the risk-free part, it's the guarantee part, the put part. If you look over here, this is the typical picture of the value of the put option over here on the left bottom, and it shows that the insurance goes down in value the larger the asset, it goes up in value. And that shape you see in the curve is universal, no one's particular model. So if you look at this curve, this is the value. Now look at this point. Let's say we start at this point of assets. The guarantee, the put's worth this amount. What happens if the assets fall in value to this level? Well, the first thing you see is what? The put value, the guarantee value goes up, which means the value of the loan goes down. That's the first lesson. Actually, if you do this, you're ahead of the way the things are often done in banks. When that happens, they don't usually reduce the value of the loan they carry on the book, even though it really did fall, you can see. But the part I want you to see that's more subtle, you see this point here? Do you see this slope of line? If I asked you the question, if this asset moved up or down by $1, how much would our guarantee, our put, change in value? It's going to be roughly that slope. So if that slope was minus 0.1, what that means is a $1 decrease in the asset will cause the guarantee to go up by about 10 cents. Okay? And that tells us locally roughly the risk that we're taking writing this guarantee, the risk we're taking in this bond due to the uncertainty of the changing value of the assets. Look what's true over here, and this is the part I want you to see from the picture. We saw the guarantee went up in value, right? But what else do we see? Now if I ask the same question, $1 move, from here, what do we see? It's steeper. So maybe it's minus 0.15. So the first time you had a $1 move, the risk in the guarantee was 10 cents. The second time you have a $1 move, the risk isn't 10 cents, it's 15 cents. It's gone up. This has a jargon term, it's called convexity. All right? Now you have a jargon term. What it says is the risk is changing and it's increasing as you move in that direction. Why is this important? If I make a loan in a bank and the assets, let us say residential housing, for example, this is a mortgage, goes down, then we saw the value of that loan goes down, so that means the capital of the bank is lower, right? Which would seem to make it riskier. But what else has happened? That same loan is itself more risky. So you get double riskiness. You get the riskiness because the value is going down, and so it's more leveraged in that sense. but you're also getting a steeper change in what value is there. And this labored thing I've taken through is designed to show you, by just looking at the pictures, without any mathematics or finance stuff, just other, I know put was a technical term, it's just insurance, okay? What's this show you is the insidious nature of the risk of simple credit. That you hold the same loan, and the people are paying on it. There's no problem, right? It's performing. They paid their last interest payment. But because the value of the assets fell, whether it be real estate or corporate assets, that loan's value has to fall, and its risk has to go up. Now imagine that happens not once, but it happens twice. But this time, of course, it's now 15 cents. What happens if it happens a third time? You see it keeps getting steeper? This is what happened in part to every bank in the crisis. You had shock after shock. You had residential housing coming down many parts of the world. You had corporate assets fall. After all, the world stock markets between September of 2008 and March of 2009 dropped between 30 and 45%. That means corporate assets value went down. So you can imagine what that means for loans. So if you want to understand how the risk of a bank can change radically without them doing any different or new transaction, without adding 1 cent more of loans, this is giving you a guidepost to understanding that. Okay. End of credit. You've paid the price. You're now all certified credit experts. All right? But keep this in mind. Now we go to one of the things I want to point out that's related to the crisis. These guarantees. As you know, sovereigns guarantee their banks. Sometimes explicitly, there's a rule, deposit insurance, and sometimes implicitly. There's no formal rule, but they do it. The US has done it, the UK has done it, everybody's done it. Governments do that. Okay? So governments are writing guarantees on banks. Notice, therefore, what? It means that the government has a liability because it's guaranteed the bank assets. It's written a put option. But the bank assets are really riskless lending and plus a put option or insurance policy. So the bank, the government, is really writing an insurance policy on an insurance policy of the whoever is borrowing from the bank. It's writing a put on a put. Now, what does that mean, just technically? If you looked at what happens to the government, not as a function of bank assets, but a function of the assets that underlie the bank assets, real estate, corporate assets, it's a put on a put. The slope is really, really steep. For the jargon types, or the math types, it's double convexity. It's a convex function of a convex function, which is very convex. That's how governments get into trouble, can fast. I'm not talking about phony books. I'm talking about real economics. You can be down on the flat part of the curve, it's almost no risk. You get a couple of shocks, real estate and loans, leave aside currencies, these things can grow dramatically. So now you're feeling that. So governments write guarantees, but you now see the exposure the government is taking to do that. But what's a typical practice by a sovereign, particularly a sovereign that's having a little fiscal problems or financial problems of its own? The sovereign will often go to its banks and say, what? We have a great investment for you. We think you ought to buy the government's bonds. Have you heard of that happening? No? You haven't? Well, okay, I can give you a couple of cases maybe in Europe, even some here in Asia. But in any case, so what do we know? If the bank buys the government's bond, what's the bank doing? We already saw. It's writing a guarantee on the assets of whomever it's lending to. That's the government. So what do we have in this situation? when a bank holds the sovereign's debt and the sovereign guarantees the banks, you have the guarantor guaranteeing and being guaranteed by the guarantor. You have what's called, if we could do it here, we'll make him the sovereign. I'll be just a bank, okay? We know he's guaranteed me, but because I'm holding his bonds, I've guaranteed him. So let me just take you one step through. I get into trouble. I don't want to blame you. I get into trouble, what do we see? The guarantee on me from him goes up, right? His capital goes down. He's weakened. But what? If he's weakened, I wrote a guarantee on him. So the guarantee on him has gone up. That weakens me. But then, of course, that weakens him more. You see what's called a feedback loop. Now, you might ask, why would we ever enter into contracts like this? Well, as you can see, it's all over the place. And in fact, if you want to understand something about Europe, okay, and this is a fancier version, that's a lot of what the European debt problem is. You have European banks, individual country banks, owning not only the debt of their own sovereign, but the debt of the other sovereigns. So German banks own Greek debt or Italian debt or Spanish debt. Spanish banks own Italian debt, et cetera, et cetera, et cetera. And you now have, if you start to look at the connections, you have the two banks in the different countries do business with each other. They lend to one another, which is a credit sensitivity. You have this bank with its own sovereign. We've already been through that. We have this bank with this sovereign, but we have this bank investing in that sovereign, that bank investing in this sovereign. Do you see how there's a lot of interconnectivity? You now get a hint why it's not simple to say, hey, let's just let those banks go and let the sovereign look after them, because there are a whole bunch of feedbacks that go through this that make it very complicated. The outcomes of this are not simple the way you might do it on the back of an envelope. And it's this kind of connection of credit that I'm trying to motivate you to see before, now I promised you the pictures, all right? So let me tell you, there's one more technical aspect. We wanted to measure the degree of credit connectivity among sovereigns. We use banks and insurance companies because that's where we had the data. My co-authors from the IMF, and we were able to get data that's not proprietary, but let's say it's data that's not easy to get. I would have loved to have pension funds, but unfortunately I didn't have it. Maybe we'll do it. So these are the data, what we have. And what we're going to do with that, What we're going to do with that is we're going to fit the following thing. There's a thing called an expected loss ratio. That's just the ratio of the cost of the guarantee to the amount of the debt being guaranteed. So it's a number like 6%. It would mean you have to pay 6% to someone to guarantee the debt, that piece of paper. If it's 4%, it's a lower rate. That means you're better credit. If it's 0, it means you're a perfect credit. The guarantee costs nothing. Does everybody understand? So that ratio, the larger it is, the worse credit you are, the more you have to pay for the insurance. All right? So what we're going to do is take that number for sovereigns, for banks, and for insurance companies, and we're going to ask the question, if we look at the level of credit for institution J or for sovereign J today, or last month, and we compare it to the credit of institution or sovereign K next month, are they related? Are they connected? And if so, are they significantly connected? So we essentially do a regression. Now, if you don't know about regressions, it's Granger calls out, it doesn't matter. If you do, you do. It just says we're trying to measure, in some sense, the impact of this institution's credit this month on that institution or sovereign's credit next month. All right? And we do this with the data. So we ask ourselves, are they there? We only look at what are called significant coefficients, where the statistics say this relationship that we've measured is significantly different from 0. It's meaningful. It's just not by chance. And then we say that if it's significant for this coefficient, we say, therefore, the credit of J will influence the credit of K. Now, you have to be careful. It's not literal causality, but it just says we see an association that if J's credit changes this month, K's credit changes the next month, and the predictable coefficient is by that the amount of B. Does everybody get the sense of this, all right? But we can also ask the reverse question. What about if we look at K's credit this month and ask its influence on J's credit next month, the opposite direction? And ask the question, is it significant? If so, K influences J. If both this coefficient and this coefficient are significant, then we say J affects K, but K affects J. That's what you just saw. We're in feedback. What happens to him influences my credit. What happens to me then influences his. Does everybody kind of get a sense of what these numbers are and what we're measuring? Now, I will very quickly, and I promise it gets better, prettier pictures anyway. This is a bunch of equations. All this is telling anyone in the audience is we just did this simple pair connection. One point in time, another point in time between two. You can do a more generalized things where you consider the thing with itself at an earlier date with the future, a whole bunch of terms, 1 month, 2 months, 5 months earlier, okay? All I'm trying to say is what I show you in the simple form generalizes to a much more general model if you choose to do it, okay? Now, what we did is we had data from 2001 to 2012 monthly. We had 17 sovereigns, 63 banks, 39 insurance companies. That's 102 institutions. If you look at the number of ways in which these combinations of things can go, you multiply them, you get 1,734, okay? Connections, potential. If you multiply them both ways and you look at all the coefficients, you can get up to 28,000 Bs if you looked at all the different ways. I'm not going to show you the 28,000 Bs. I'm not going to put a pile of statistical numbers on the table here for you to all look at or run for the next 15 minutes on a screen. What I'm going to try to do is to take the results of all of these measures of connectedness. You understand the sense of connectedness now? Connectedness only with respect to credit. So if a bank does a lot of business with another bank but it has no credit, you know, they're just doing transactions, it won't show up here. If a sovereign is doing a lot of things but it doesn't affect credit, only credit, which remember, credit's pretty important. That's where this darn crisis came from. But I want you to remember that. So some of the things you'll see may look counterintuitive, but they're because you may be thinking that they do a lot of business with each other, but they turn out not to be connected. And what we did is, in measuring the guarantee, a natural thing to use is market prices for the guarantee. Those of you who know this, there's a market called the credit default swap market, in which guarantees of both sovereigns and corporations and banks and insurance companies trade. You can buy and sell these guarantees. We could have used those prices, and we did for the sovereigns. So you ask, where do we get the data, to measure the credit? We're using actual market prices, CDS prices there. Just think of those, the guarantee prices traded in the market for sovereigns. We did not do that for banks and insurance companies. The reason is we want to measure the total credit risk of the institution, what it would take to pay to guarantee the total credit. The market for a bank CDS is only for the private sector component of the risk. Let me give you an example to illustrate what I'm talking about. Suppose you have a really crummy bank. We all would recognize it's crummy. It's in bad shape. But the government puts a full faith and credit guarantee on all the debt. What's the CDS what's the risk to the private market? There's no credit risk, right? Because as long as the government pays, it's like your deposit insurance. You don't care if your bank doesn't any good as long as it's guaranteed. So if we looked at the CDS, it would look like zero. When in reality, it's a very risky, because the CDS only measures the private market's share of the risk, not the total risk. We want the total risk. Otherwise, you get very strange measures. Like when Ireland, the government of Ireland guaranteed all the Irish banks, the day that happened, the cost of guarantees for Irish banks fell. Is that because the Irish banks got better balance sheets? No. It's because the Irish government says we're going to guarantee all the debt. Well, what do you think happened to the CDS of the country? It went to the moon. And so you went. So to do this correctly to your intuition, we have to measure the total risk. Therefore, we don't use CDS, we use a model that has been used for decades in the practicing world. A version of it is KMV, which is owned by Moody's. The model has some connection with me in the sense that some people have called it the Merton model, but it's a much better model now than anything I ever dreamed of. But I'm happy to keep the name on it if it works. Okay. What I'm saying to you is we use the model rather than the market prices, but the models are based on market prices. But it's a model that's market proven. It's used throughout practice, throughout the world, has been for decades. We're not trading on these numbers. So we feel very comfortable that the numbers that are coming here are good estimates for the purposes of understanding the magnitudes. You understand what I'm saying? So I want to be clear that we're not just using those market prices, and I've given you the reason. All right? Ready for the pictures of all of this? So as I said to you, I wanted to try to give you a way of containing all this information about all these interconnections, not just the two of us, but if all of you are, remember 102 institutions, 17 banks? That's almost as many people as in this room. If we all looked at all our connections with each other and how they're changing every day, that'd be pretty complicated, even if it was 2 by 2. So how do I display this to you? And the way I display it to you is this picture. Now, let me explain what this picture is. From now on, just pictures, okay? So we've crossed the Rubicon of this. If you have the eyesight, these blue names along here are insurance companies. 39 of them. The black are the sovereigns, Italy, US, et cetera, et cetera. And the reds are banks, 63 of them. And what we did was taking only the significant connections, not all possible connections, but only the ones that are material, and drawing those. And then moving around things in there, so using a method called principal components, doesn't matter, eigenvalues, whatever, eigenfunctions. Looking at the ones that are the most connected, that is to say they have the most different influences with so many people, and moving them closer together visually. All of this is trying to give you a visual representation. You know the story, one picture is worth 1,000 words? Well, I'm hoping that 1 or 2 pictures is worth 28,000 regression coefficients. That to try to convert so your mind looking at a picture can grasp a large amount of information, not necessarily in detail, and I'm going to show you how it works, but that's the spirit. So what we've done is put all the connections in, the blues, the reds, the blacks that are significant, for the period prior to the crisis, 2004, 2007. Now, I want you to look really carefully at this. You're looking careful? Now I'm going to show you the next one. Anything different? One more time. Look at that. Now look at this. Anything different to your eye? You're just say no to everything, right? He wants to make sure that nothing's unanimous. That's okay. We will record that we have a permanent no vote. All right. What I want you to see from this, before we do anything more, that first of all, you saw it changed. You saw it gets a lot more intense in color and density. Now remember what these lines are. They're connectedness that are significant among all these different banks, insurance companies, and governments. So what does this tell you before you know anything else? You can't even read these things from there. This is like Google Maps. You know, you get up and you take a look at a good part of a country, right? You see all of these things. And then we're going to kind of zoom in. But let's just get the first effect. The first effect you get from the picture is something changed between pre and post crisis, or pre and during crisis. And what clearly changed is a much greater degree of connectiveness, much stronger and many more. And if you wanted to get a little good at it, you can look at the shadings to see which got a lot more red, a lot more banks, or a lot more black, a lot more sovereigns, whatever. But that's the message this picture is telling you. The first message out of here is connectiveness with respect to credit sensitivity changes. And in particular, pre to post-crisis or pre to crisis, it became much more intense. Now, that's not necessarily bad. You shouldn't read this as bad. It's just a fact of the data. But it does suggest that we're a lot more connected here in terms of credit, which could mean sometimes you're more stable because you're all connected together, but what can also mean is that you're more vulnerable. Because if you're highly connected, then if there's a shock, remember the two of us? I got into trouble, and the next thing you know, he got into trouble, then I got more. Well, now suppose we got all the connectedness that you've seen, and you can see how it can bounce around and get really quite exciting, all right? So it's not bad, but it's probably an indicator of a vulnerability. And you can think of this as somewhat like a heat map, if you've seen these infrared things. It gives you a sense, something's maybe changed, and maybe this is telling us something that we ought to look into. All right? Now let me give you a couple of blow-ups of certain dates. This is August of 2008, before Lehman. If you look here, here's Greece. Now, if you could see the lines, I don't know if you can see them here. This line to here, it has an arrow on it. What is that arrow conveying? The arrow is conveying that if the arrowhead goes that way, it means Greece is impacting that insurance company that's blue. If the arrow went the other way, it means the insurance company is impacting Greece. And if there were arrows in both directions on that line, we're back together and each of us influence. So from the picture, if you blow it up, you get more and more information. You not only see the connectedness, you see which way the connectedness is. And by the way, as you'll see in a few pictures from now, that connectedness changes through time and actually can reverse direction. So you get a sense of the intensity by their closeness of the various sovereigns with Greece and how Greece is pretty into it. Okay, I'm not going to interpret each of these because we're late. Here's Spain. I want to point out, here's a map in December of 2011. This is before Spain actually was officially in trouble. It isn't that people weren't worried, they were, but this is before, it was 2012 when Spain started to get into it. And here you see it here, out here, with various connections and so forth, but it's kind of out here. If you look in here, you're going to find Italy and others are more in the real. But it was being picked up already before a formal statement that Spain was in trouble. There was a lot of connection, which would suggest vulnerability. All right? Now let me go to another one. March 2012. This is an election year for the US president. What you see up at the top, where you see the thing that says US, here's the largest economy in the world, the Federal Reserve, which is certainly the most influential central bank in the world. How could it not be that connected? Wouldn't you think it had to be? Look where it is. See how little lines go to the US? Almost nothing. What's wrong? Remember, this is only credit. It's not the amount of business that the U.S. does, number of imports or exports or bills of lading. This is about credit. One could perhaps explain, and I'm not trying to tell you, I'm just trying to give you a way of thinking of how to use this tool. If you think about it, in 2012, there was no way, politically, that the United States was going to step up and guarantee, again, ECB or anybody else. Just wasn't going to happen. So therefore, the U.S. was really not very connected with respect to credit to the rest of what was going on. On the flip side, I don't think there were very many in March of 2012 who were worried about the U.S. credit rating. In fact, most of the money was fleeing, in some sense, to the U.S. vis-a-vis most of these other areas. Okay? So you can sort of see, from a credit point of view, the U.S. might, it might be really telling us something, the fact. It's conceivable. I'm just giving you an interpretation. We haven't gone through these data. I'm just trying to, do you understand? I'm trying to give you a sense of how things that might seem counterintuitive, once you see it. And on the other hand, same time, here's Italy. Right in there, lots going on. By the way, the UK was also relatively unconnected, as was Switzerland and Sweden, which were probably less of a surprise, okay, on those dates. Now, let me drill down a little more. See how the pictures, it's like, pretty soon we're going to look at someone's picture on their front porch. Okay. Here's Italy in that same date, and lots of arrows. Now you can see a lot of the arrowheads. This red one is a U.S. bank. That's Spain. The two look like they're married. See how close together they are? And for this one, you see a lot of arrows coming into this bank. Now, there's nothing wrong with what I'm about to say. The bank, if you can't see it, has the symbol GS for Goldman Sachs. I have no idea why all this was there and why they were so close together. There's certainly nothing sinister about it or anything. There's nothing to worry about, except it might be interesting as a question. Just as when we saw the U.S., when we were higher up, was way up, this map is not answering questions, it's asking questions. It's saying, you ought to take a look at this. Isn't this interesting? The U.S. is out of it. It raises the question, why? Do you think it might be of some interest to official people or people running assets to see that? They might want to ask that question and try to find the answer. I don't know whether anyone would be interested in Goldman Sachs at that time, but if you were and you saw all of this coming in, you might say, why? And then use other sources to try to find out, either official sources, if you're official, or if you're a large investor, do some investigating. So what I want to tell you about this tool at this stage, it isn't going to answer questions so much as it's going to ask questions. But that's a very valuable role, because you have thousands and thousands and thousands of possible questions you can ask. Put a different way, there are thousands and thousands and thousands of stress test scenarios that you can run. There are an uncountable number of scenarios, so even after you've taken thousands and thousands, there's an uncountable number that you still haven't looked at. So a map like this, at this stage, at best, it'll get better, in my view, but at this stage, its biggest value is asking questions. Asking you, saying, look at the map, why and where to look, where to ask questions. I give you some potential interpretations, but without confirmation of real data or knowledge or talking to people or finding out why, that's pure speculation. You don't put policy on speculation. You don't take investments on speculation. So that's what this purpose is, and this is how it can be used. But think about all these relations you're seeing. All right, how much time do I have left? 5 more minutes, okay. Well, let me then show you some dynamics of change. So you saw the big picture, you saw what is day, you saw the shock of a one. Now what I want you to see is the following. We plotted here from back in December of '03 up to March, so well before the crisis to here. The blue line are a fraction of all connections from sovereigns that were significant where the arrow came from the sovereign to someone else. So from the sovereign to the bank. That's what from means. the sovereign was affecting the bank. Agreed? This is measuring how much of the possible connections of 100% were of that sort. Back here, less than 10% was the sovereign affecting other institutions. It grew till here. It hit 30. Here, March of 08, before September, it was as high as 50%. You see how much it's changed? A number of cases in which the sovereign is affecting the other institution through time. And that's all the way through. The red one is the opposite. This is the arrow from me to him. And you see a similar pattern. Do you see how much they change? Remember, this axis, when it says percentage, take all the possible connections there could be, and what fraction of them are significant and going with the arrow in one direction or the other. What I want you to see is how it changed through time, including in directions. At times the blue, and the red, the blue was above the red, then the red's above the blue. It's telling you how much these connections change. I was asked earlier, not too long ago in an interview, what are the connections? And I said, what day do you want to look at them? The point is, it depends. At one point in time, it changes. That's important to understand. All right? Now I've added, in addition to banks affecting sovereign, sovereign affects bank, here are one country affecting another. That's the light blue line. Down here, it goes way up here in March of 08, and then really peaks up all the way up in 06, and then comes way down. All right, so I'm not going to go through each, I only have. Now, this one. There were 5 countries that have gotten special attention in this, and there's a somewhat pejorative acronym for them, starting with Portugal for P. We chose to move it around. The best we came up with was GIIPS. Not the great one, but I couldn't think of another. But in any case, what we've measured here is from those 5 countries influencing others, minus from others influencing them. It's the difference. So you can look at all the arrows where these countries are affecting, and then minus all the arrows that are affecting them, pushing them back, and look at the net. What do you see? Before the crisis, very negative. What does that mean? Mainly, these countries were being pushed around by the rest of the world. That's not, when I say push, that's sort of, you understand. They were being influenced by the rest of the world. That makes sense. Greece is a small economy. Portugal is a small, Italy is a pretty sizable economy. But, that's the way it was going. Look what happens around, say, September 08 in this region. Suddenly, they're pushing around an awful lot. You may recall Greece, those things, influences well beyond their sizes. And then you see it move down and so forth. So do you see how you can look at the dynamic of these pictures? So you're taking a snapshot on Google Street on a point, but then you can look at the dynamic of its change and the combination of the snapshots blown up, searching through the heat map, or whatever you want to call it, and then looking at the dynamics, give you a lot of data or information or knowledge. And the secret here from network theories, these are all networks, is to try to find a way to encapsulate all of these connections in pictures that we with our magnificent brains can interpret an enormous amount of data in a way that means sense to us. And that's kind of my message to you. Last point has to do with public policy. Typically, when governments they have 3 areas of policy that I want to call attention to. Monetary policy, fiscal policy, and financial stability. They perform all 3 roles. Sometimes it's the same institution doing 2 of the 3, but government performs those 3 roles. Typically, while they talk to each other, monetary policy is run by the central bank as monetary policy. Fiscal policy is run typically by the executive branch, perhaps with the consent of the parliament. And then stability is either run by the central bank or they have a stability a board, okay, or a decision maker. And what we say is, with all this connectedness, governments have got to do better in the sense they've got to integrate the three. They've got to understand that as a matter of monetary policy, if you drive interest rates to near zero and you bring long rates down in the United States as elsewhere, very low, in the interest of the usual monetary things of trying to do stimulation, okay, then it has implications for, say, financial stability. For instance, the pension industry, pensions promise a stream of payments in the future. If interest rates go way down, it takes an awful lot of money to pay those payments. So when interest rates go down, the liabilities of the pensions go way up. In the United States, before this recent rise in interest rates, an estimate for the value of the underfunding of just our state and local governments, not the Social Security and not the corporate sector, was around $4 trillion underwater. That's a quarter of the GDP of the United States. That's a big number. 1 second. That is a consequence, in large part, of dramatically lower long-term rates, which drove the liabilities up. It's not that the assets went down. They were underfunded anyway, but they became really underfunded because the amount of money it takes to pay the bills is much higher. Think about, at 1%, how much you have to create a stream of income of 50,000 Singaporean dollars a year. 1%. It takes a lot of money. Okay? Do you think it's a little bit of a problem when you consider that the pension funds of the world hold 30% of the assets under management in the world, about 30 trillion? These are the bedrock for people's retirement, pretty important. That's a financial stability issue, of nothing else, affected by monetary policy. Does that mean they shouldn't do it? No, I didn't say that. But they ought to be cognizant that effects of one, their feedback on that and on fiscal policy. What we put together using the tools that you learned in the first part of this, remember you're now all credit experts, you remember all that convexity and curves and the shifting risks? You build all of that into the models in these that you put in this system so that they can see the impacts of the movements in terms of increasing risks for different entities and changing all the stuff that you saw, the stuff that were picked up in the heat map. And you integrate. This is not a science problem, challenge. We know how to do it. The tools we're using are market proven, not just conceptual. But it's a huge engineering problem, challenge, to do this. So it's an engineering, not a science problem. It's not like, can you do cold fusion? It's, we can do this, but it's a big challenge, okay? But this is what the map has. Now, you want me to show you what, look at this picture. Remember, I asked you to do that before. Look carefully at the picture, okay? Now I'm going to show you what the central banks of the world model is like. That looks like a plucked chicken. What happened is, in the second model, that's the models that are actually used by central banks largely, we set all the uncertainty equal to 0. We pretended that the world was a certain place. Of course, insurance has no role in a certain world. There's no nonlinearity of the things I showed you because when you know the future for sure, there's nothing to insure about. There's nothing to be. And yet, the core of macro models used in these monetary and fiscal policy things, some of them are complicated. There are certainly many variables. They do not concern the structural elements of uncertainty. Finance, by its nature and its focus, brings that to the table. That's a big step, and we think it's an important one, and it's an area for which there's going to be great research and great practical implication coming to the field to help out in this area. And that's, I hope, encourages some of you who have an interest to say, there's some interesting things to do that can matter. You do this right, you can have a big impact on the world of getting things better. And not the whole thing, but it's a step forward. So that's the world I want to leave you with. Some people looked at that big change in screen and said, oh my God, we're in a lot of trouble. Are we at risk? Yes. Are we always at risk? Yes. It's like saying it's a cold winter in Moscow. Every winter is cold in Moscow, and just so most of the time in the world. Most of the time in the world, there are always risks. The question is, can we get rid of them? Probably not many of them. Can we measure them? We have to first measure them, and sometimes we can manage them. It's a big deal. It's an exciting deal, and I'm an optimist in spite of the clear challenges we have throughout the world, that we have the tools, we know how to do it, we've always faced these challenges, and I think we'll do it again, but we certainly have the tools to do it, and I hope maybe somebody out there in the audience or two will be inspired to help the cause, and I thank you very much for your attention.